This week in Billionaires, New York State's Gaming Facility Location Board made its long-awaited recommendations for casino licenses in New York City. The board recommended bids from billionaire New York Mets owner Steve Cohen and Hard Rock next to Citi Field in Flushing, Queens, Malaysian billionaire Lim Kok Thai's Resorts World at the Aqueduct Racetrack in Jamaica, Queens, and Bally's in the Bronx. The three were the only bids still standing in the race and will now wait for the New York State Gaming Commission's formal vote to issue casino licenses at the end of December. If Bally's wins a license for its casino in the Bronx, next to a golf course it bought from President Donald Trump in 2023, the company will also have to pay Trump $115 million as part of the deal. Prediction market platform Kalshi announced it raised $1 billion in a funding round that valued the 7-year-old company at $11 billion, catapulting its young 29-year-old co-founders, Tariq Mansour and Luana Lopez Lara, into the billionaire ranks. Mansour and Lopez Lara each own an estimated 12% of the company, giving them a $1.3 billion fortune apiece. The funding round also means that Lopez Lara, a native of Brazil who studied at MIT, is now the world's youngest self-made woman billionaire. Shares in Credo Technology, which makes cables that connect data centers, have soared by nearly 250% over the past year amid the AI stock boom, minting 2 new billionaires. Credo's co-founder and chief technology officer, Chifeng Lawrence Cheng, is now worth an estimated $1.3 billion, while early Credo investor and director Pantas Sutarja is now worth $1.8 billion. Both Cheng and Sutarja got their start at semiconductor giant Marvell Technologies, which was co-founded in 1995 by Sutarja and his brother and sister-in-law. Welcome to Beyond the Billions. I'm Giacomo at Forbes, and joining me today is staff writer Brandon Kochkodin. Brandon, so great to have you here today, and you've been a reporter for more than a decade now, covering an incredible range of subjects, everything from sports to very complex financial stories. And since joining Forbes, you've been focused more on markets. How does the kind of reporting you're doing now compare to the rest of your career?
Yeah, it's very similar, but we're definitely in interesting times. One of the main differences right now is we're at these all-time highs across asset classes, and yet inflation is still well over target. And it's just, most of my career, there was no such thing as inflation, basically. I mean, we were writing stories about the worries of inflation, and we were hearing from federal bank governors, in the US saying, like, what are we going to do? This is the biggest challenge of our time, that we don't have inflation.
Right.
And now we're coming off, the biggest inflationary period in 50 years. And, it's weird right now, quite frankly, because it's, we're at highs and yet we're cutting rates. We're cutting rates and inflation's still above target. So this is kind of uncharted territory for almost everyone who's in markets right now.
And you recently wrote this great story looking at different potential bubbles right now. Everything from gold and Bitcoin to even junk debt, and obviously looking at sort of the AI craze. And you wrote, I think, what was interesting was that you said that bubbles kind of give off a scent. So when you're looking now at, with all these kinds of assets at all-time highs, I mean, crypto's come down a bit, right? But how did you set about sort of looking at those indicators and which ones kind of set off your alarms when writing about it?
Yeah, I mean, for the most part, I picked some of the classical ones just to not go too far out on a ledge thing, because I guess, part of the reason for writing this story was that there's obviously bubble talk right now. There's no doubt about that. Like, it's out there. And so just showing like some actual quantitative, metrics to show like, this is why there's bubble talk right now. But at the same time, I wanted to make clear, and I hope I did, that, yeah, these things are clues, but there's no ironclad law here. Like, just because something like the Case-Shiller index, is at a high, or just the Shiller CAPE index is at a high, that doesn't necessarily mean like trouble's around the corner. Like, if it was that easy, no one would lose money. We would all know we're in a bubble. We'd all go into hiding, sit it out. Like, these things just don't happen, on a set schedule.
And Were there some indicators that I guess you were more surprised by, or sort of weren't within that sort of more traditional group you looked at, like the CAPE index?
Yeah, I mean, I, I think the most surprising one is from another story I wrote, which is just
Hmm.
gold and stocks being at a high at the same time, which
Right.
never happens, which you can understand why. Usually, stocks is for great times, everything's going great, I want to own that. And gold is for like, oh no, I think something bad's going to happen
Right.
for the most part. That's a lot of gold. And to see these two things moving in tandem, both at all-time highs around this, basically at the same time, it's just weird and it's hard to explain. And, people have ideas why it's happening, but, it, it's who knows?
Hmm. Were there any sort of more compelling explanations you got in your reporting for why that is?
Yeah, I mean, the general one is just it's a bet against the dollar both
Hmm.
ways. That there's this thought of there's too much debt in the U.S. Everything that's happening with tariffs, you know, whatever your thoughts are on the current administration, that dictates some of your view on the dollar. So that one makes a bit of sense, except for when you look at what's been happening with the dollar, it hasn't been that bad. So
Hmm.
it's, you know, markets are forward looking. It could be a in expectation that something's going to happen with the dollar, but that really hasn't happened quite yet. Um, so that's the one that makes the most sense. But you still have to take a little bit of a leap of faith there to
Hmm.
totally buy that argument.
And when it comes to the stock side of it, right? Obviously, like that's at a all-time highs as well. There was some volatility earlier in the year, right, around tariffs. How are you sort of thinking through that as an indicator of potential bubble, or sort of whether it's we're veering into reckless excitement, or whether it's sort of just that there are strong fundamentals, for the big tech stocks, for example.
Yeah, I mean, I think one of the things I have particularly focused on, especially since 2020, the whole meme stock thing is just
Hmm.
your classic apocryphal story about the shoe shine boy giving stock tips.
Hmm.
And in 2020, that was absolutely the case. I mean, you couldn't open up Twitter or X or anything like
Right.
that without someone pumping a stock. I don't know that there's that much of that right now. And
Hmm.
it like, certainly we hear about AI every single day and it's nonstop. Um, but the companies, at least in public markets, that are involved in the AI trade, like they're for the most part really, really good companies, really strong
Hmm.
companies where they can afford to take some big bets on this. Um, and we see different things in private markets where okay, maybe there's stuff happening there. We don't get to see the financials. We get
Right.
to see the headlines on OpenAI at $1 trillion valuation, things like
Yeah, like
that.
100 billion funding rounds every week, and yeah.
Exactly. And so there's open questions there, and we should all be, you know, skeptical of until we see numbers. But yeah, I mean, my outlook right now is just like all the numbers are basically showing like, hey, look, we're obviously at all-time highs. Multiples are absolutely getting stretched. I just don't get the sense that there is this like bubble fervor in stocks right now. In some individual names, of course, but Nvidia's come off a bit. It hasn't,
Hmm.
but I don't know, you just don't see that sort of craziness that you typically see at absolute level tops.
Or I guess for me, there was some kind of somewhat of a parallel, but not the same. To your point, to like 2021 when you had the SPAC boom, right, and a lot of biotech companies. And at the time, I think there was a lot more skepticism, right? It wasn't being driven by the likes of these big tech companies that are very solid companies, right? It was a lot of newer firms or pharma firms that maybe didn't, like Moderna and the vaccine companies come down a lot. I guess, do you see this as sort of very different from that last big boom we saw?
Yeah, absolutely. I mean, you see, when you see the stocks getting kind of touted now, like it is Nvidia, it is
Hmm.
like a Google, like these are real, like we know these are real companies.
Yeah.
Before it was GameStop,
Right.
AMC, like things where it was just like, okay, we know what's happening here. We know it's
Yeah.
someone trying to buy, hoping the pump keeps happening. I'm going to sell later, and unfortunately, someone's going to be left without a chair. It just doesn't feel that way right now, to me at least.
And I want to dig in a bit more into the AI spending. I think you wrote in another piece that I encourage everyone to read that infrastructure spending on AI could reach up to 5.7 trillion, I think. And obviously a lot of that is from these big public names, but then a lot of it is also from these private companies or from other firms that we don't have as much visibility into. What do you see as the risks potentially of that, or obviously AI is a huge spender of growth right now, right? Driver of growth, sorry. Um, so I guess how are you thinking about that, and if you could sort of unpack that other really good story that you did on that.
Yeah, the risk is the same as anything with this, right? Like there's a limited amount of money in the world,
Right.
kind of, um, and it's being diverted into this one highly concentrated bet. And the thing that's sort of different here than maybe past episodes like this is like AI is going to work or it's not going to work, right? And everyone's doing kind of the same thing. Like you need the GPUs, you need the data
Hmm.
centers. Um, so if it goes right, like great, a bunch of companies presumably are going to win. Although there is that argument out there of like whoever gets to AGI first becomes essentially a monopoly, and you're never going to be able to catch them.
Yeah, they can't
Um,
all win, right? To the same
exactly,
degree. Yeah.
exactly. But anyway, it's the risk here is beyond just AI failing, which I don't think I'm not an expert there, but it seems unlikely that AI is going to totally flop given
Hmm.
what we know. Um, but it's that money's all a lot of money's going all into this one spot. So where isn't it going? And it's who's getting starved. And then the other aspect is when you have to borrow trillions upon trillions of dollars, which is going to happen, interest rate, effective interest rates are going to go up. We're already seeing that. Like a company like, a Meta or a Google or Oracle, they're paying more now than what they were before for interest on their bonds. And it's,
Hmm.
as rates are coming down, and it's just a fight to get people to sign up to lend the money. And that doesn't just affect them. Like it's not that doesn't just stay in a little corner. Like everyone else in the market then says, well, hey, look, Meta is a great company. They have tons of money. Like I have no worry about them paying me back, and they're willing to pay me this. So if I'm going to lend to you, you have to pay me at least that, if not more, and probably more. Uh, so I mean that's one of these interesting dynamics is like if you look at this at a whole big macro level, it's like we're you know the Fed is cutting right now, trying to bring interest rates down, but this dynamic of AI borrowing could could also drive rates up on its own.
And I think it's interesting, right? It's companies that probably have nothing to do with AI, right? That are then getting exposed to those higher rates. Are there? I know you mentioned some examples in the story, but do you see sort of any industries or particular um, type of company that'll be most affected by this, or is already the most affected by this?
What I mean, what we're already seeing is spreads are widening. Um, so it's going to happen everywhere. It's not just maybe I suppose you can come up with an argument saying like, hey, if you're um, you know consumer staples or something, like if you're
Hmm.
Campbell's soup, that like, hey, you're completely in a sense isolated from this, and so you know your money good, like it's fine, we're not going to charge you, we're not going to ask for more because you're not affected. But at the end of the day, it's like when you have the bluest of blue chip companies that are willing to pay more, it has to raise rates for everybody. So I don't think anyone's going to um, not be affected by it.
Hmm. And going back to the sort of these large private companies like OpenAI, right, that are raising a lot of debt. There was a suggestion, I think, from an OpenAI executive that there could be some sort of potential for a federal backstop, right? Federal government backstop. An idea that I think was pretty unpopular when it sort of made the rounds social media. Um, how sort of likely does something like that look? I mean, obviously they're a private company. They have a lot of very wealthy backers and investors, and it's kind of sort of the biggest whale out there, right? That's not publicly traded. What was kind of the reaction to that, and are there precedents for this kind of a backstop?
Yeah, well, the reaction was pretty negative
Right.
from the get-go. Um, and it was fair, but there was an unfair aspect to it as well because people were saying, calling it as a bailout right away, and that's not quite what she was saying.
Hmm.
Sarah Fryer, the CFO, like what she was saying was a government guarantee, which well, if you want to construe that as a backstop or as a bailout, it's not totally off base, but it's also not explicitly,
Hmm.
they're not asking for a bailout right now, a potential one perhaps. Um, but how likely is it? I don't think it's off the table. I mean, we just got an announcement last week about like the Manhattan Project for AI and
Right.
government investing. So like, if it really is, and maybe it should be, maybe it shouldn't be, considered a national strategic priority, like that's a lever you could reasonably pull. Keeping the cost of capital down so that American companies can compete. Like you can make an argument that it's not as outlandish as it sounds. Um, for precedent, I mean, the housing market would,
Hmm.
government guarantees in the housing market. You can look what's been done over the years with student loans, and not quite the same, but you know, the government's involved there. So it's not totally, uh, wouldn't be unprecedented.
And this administration, like to your point about national security implications, has been taking several stakes in private companies, right? In semiconductors, rare earths, that is kind of unorthodox, I guess, for the U.S., but that they have presented, I guess, is right. The government is investing in critical national security industries, right? So I guess you could make a similar argument here, like
Yeah,
you were saying, right?
yeah, and it all, like I said, I mean, it all ties into like if the goal over the next whatever year or 2 years is to bring interest rates down, one way that they could do that is to give a guarantee here. Like that would
Right.
lower rates for everyone, across the market if there's a government guarantee there. So
Hmm. And going back to what you said before, that it's really hard to make actual predictions about recessions, right? You wrote sort of about the yield curve, right? It was inverted for almost 2 years, right? And that usually portends a recession within, I think, 24 months.
yeah,
And we obviously didn't see that. So I guess how common is that? Is it for that to happen? And how are you thinking about that now as an indicator that didn't come true in the last couple of years? And I mean, I even remember 2023, even 2024. There was all this talk of when is the recession coming, and then it didn't come, right?
yeah, yeah. I mean, it's been a pretty reliable indicator. You've had debates over the years on like which yield curve you should be
Right.
looking at and which one's most predictive, and when you can get into arguments there about like which one should it be and which and there's always this the people that want to say that the yield curve is the ultimate indicator, like there's probably some cherry picking of like, well, this one has the better record now, so this is the one we're using, and
Hmm.
whatever. um, but yeah, I mean, even when it flipped, I think I originally wrote a story,
Right.
2 3 years ago saying like, hey, it's not working right now, like this should have happened, and why isn't it happening? And so now we've got all these sort of explanations out there, and there was this you know thought out there of like, well, it's the AI spending which sort of came out of nowhere, and that's what's keeping us out. And like that's a it's a fun explanation, and it certainly it makes some sense. But at the end of the day, it's like there's a recession or there's not. Like it was
Hmm.
predicted or it wasn't. And like the fact that the spending came from AI capex, like I don't know that that necessarily changes all that much if you're looking at it at a you know, broad lens. Where I think maybe there's things that we should be looking into is pockets and
Hmm.
different aspects of the economy that are suffering more or less. Certainly tech isn't, but Manufacturing is a different story. But then you get to questions of like, well, how much does that matter overall for the economy if we're mostly attacking financial economy and they're doing well? Like, you know, what else do you want?
I mean, to that point, I think that the Magnificent Seven now make up around 40% of the S&P, right? Is that I guess what do you think about that data point? Is it does it matter that it's that concentrated? Does it in terms of any potential bubble bursting or sort of the impact on sort of the average stock investor, or is it just sort of a fact that that's where the growth is and there's nothing positive or negative about it?
Yeah, I mean, I think it's just sort of a fact, right?
Right.
Like that you're looking at a high margin industry. So like we
Mm-hmm.
should expect that it's going to eventually outpace like but if you're thinking about in terms of investing, I guess the question would for me go to like, okay, if you're just going to buy a broad-based index, like you got to think about this now. Like
Mm-hmm.
just buying the S&P 500, are you actually diversified?
Right.
Probably not. Like you probably shouldn't just say, oh, I bought the S&P, you know, one-stop shop, I'm
Mm-hmm.
good. I think you do have to start thinking about like what the implications are. But in terms of the 40% data point, it's sort of, it is what it is. Like, what are you going to do? You know?
Right. And as far, I guess, as any potential corrections, I think since your story mentioned earlier that Bitcoin has come down a bit. Obviously it's still high relative to the last few years, but do you sort of have any thoughts on why that is, or whether you're seeing that in any other of the assets you were tracking, or is that sort of just more specific to the crypto markets?
With Bitcoin, certainly we're seeing institutional adoption. We've seen the
Mm-hmm.
ETFs. We're seeing it work its way into managed portfolios.
Right.
We're seeing legal changes across the board that are pro Bitcoin, make it easier
Mm-hmm.
to hold, reporting for all these sort of things. So that, I mean, that makes sense to me. You can make arguments that Bitcoin is, um, by the nature of it, that it's a 24/7 global asset, that it's kind of a canary in the coal mine, right? And I think specifically the way I look at Bitcoin personally is as the liquidity cage. It's going to go up when more liquidity is coming into the system.
Mm-hmm.
When we start to see liquidity tighten or potentially tighten, you're going to see it drift quicker than other assets, at least for now. Um, so, you know, I don't know that there's part of it that's unique to Bitcoin because
Mm-hmm.
of these changes and, becoming professionalized in a sense. Um, but there is also this aspect of like, is it telling us something about other markets? And I think it is, right? Like we know what's happening with liquidity right now. Like it's tight. Is it going to be tight forever? I don't think so. And I think that's why it's holding up and we haven't seen a huge crash.
And I guess obviously you're an accomplished financial reporter, not a sort of financial advice columnist, but how are you, I guess, thinking about your own um, investments, or what advice would you give to people trying to navigate this kind of uncertain world right now? Like, you were talking about with gold and stocks both high and sort of inflation is, how should people think about it?
I think the first thing is you have to know yourself, right? Like, what's your timeline? Are you planning to retire 6 months from now, or
Mm-hmm.
6 years from now, or, 30 years from now?
Right.
And you should be doing the things that we all know you should be doing there, right? Like, if you're planning on retiring from 6 months, you shouldn't be 100% in the stock market. Like, that doesn't make sense. If you're planning on retiring 20 years from now, like, should you really be caring too much about like trying to time a potential crash? Like, no, like you know, I think it was Peter Lynch that said, right, like more money's been lost preparing for corrections than in corrections themselves.
Mm-hmm.
Like, look, it's impossible to time these things. Like, you probably don't want to do that. But I think the things you can do are like, look, we talked about the diversification point. Like, you should question these things. Like, if the S&P 500 is 40% tech, and that 40% tech is basically betting 100% of their future on AI, like, do you want a 40% AI bet? maybe you do, maybe you don't. Like, who knows how this is going to work out? Um, but you should at least be aware of those sort of things. And, um, you know, all the other basics apply, right? Like have a cash buffer, those sort of things. And then, just the general stuff. I mean, have a career, be prepared there, like, try to make more money on your own with your career. Not, investing should not be, unless you're a professional investor, it should not be your main source of wealth.
Well, I'm sure we're going to keep checking in on all these indicators and more. And obviously, we have so many people covering AI here. But it's been so great to chat with you today. And thanks so much for coming on. Really appreciate it.
Thank you.
You can find Brandon's stories and the other stories we covered in this episode in the show notes.